future value is positive influence. Make sure your signs are going the right way. The calculator won't like it. Put them all at positive. Okay? You ask the calculator to spit out 4%. That is less than 10%. Hurrah! Is that your yield to maturity? Why not? We have to annualize it. Yield to maturity is always annualized. We fed in a bunch of semi-annual quantities. Right? The calculator is going to spit out a semi-annual quantity. Right? That's a semi-annual discount rate. So to get your yield to maturity, you must annualize it. You must double it. It is still less than 10%. Hurrah. Which is good, because we thought it had to be because the bond is a premium bond. Okay. Any questions about that? So as long as we can observe a price of our bond, the price of a bond, we know the other features of it. We know the coupon payment, we know the face value, we know the time to maturity, the number of coupon payments to maturity. We can estimate the yield to maturity. Okay? Just be careful, we have to annualize it. That's one other thing. Good? Good. Last thing, and we'll move on to talk about stocks in a second. So factors are going to affect the required return, the yield to maturity. Well, anything that's going to affect the cash flows associated with the bond, right? Anything that's going to affect the expected cash flows of the company, right? So default risk, or what we call default premium, right? If there's a change in the likelihood that the company's going to be able to pay the money out, that's going to impact your required return, right? Inflation premium, as we talked about before, if I'm buying this bond, it's a 30-year bond, I know that those dollars I'm handing over now are not going to be the same as those dollars I get back in 30 years. I need compensation for that, right? So again, you can think about any changes in inflation expectations. If all of a sudden we think inflation is going to rise a lot, well, required returns are going to go up. Price of the bond is going to go down, right? So changes in these values will change the yield to maturity, change the price of the bond. Liquidity premium, we didn't talk very much about this. Bonds don't trade very often, right? Stocks trade millions of times a day, whatever, right? Bonds, when they're first issued, the first month or so, they'll trade. They'll trade maybe 100 times a day or something like that. But then they settle into those, especially high-grade bonds, they settle into those insurance and pension portfolios, and they just sit there for years. You have bonds that don't trade at all in a given month, right? But here's the problem. You buy a bond, you have a liquidity event, and you need to sell the bond. Who's buying it? Nobody right now. Right? Everyone's kind of moved on. They don't need that bond. They have theirs. So the more illiquid your bond is, and we'll talk about liquidity here, your ability to sell an asset near its intrinsic value. Right? You can sell anything by cutting the price. Right? The more illiquid the bond is, the less it trades, the more you ask for a return. Because if I have to sell this thing, I'm going to have to give up some value. Right? Mike and I both think, we both estimate that it's worth $1,000, but he's not really interested, But, if I say, all right, well, you buy it for $950, yeah, I'll pay $950 for it. I wasn't really interested, but you cut the price, but I had to take a loss to move the bond, right? So the more illiquid the bond is, the more I ask for in return. And the liquidity fluctuates through time. So if liquidity changes, if markets are hotter or colder, that can change the value of the bond. So at the end of the day, anything that affects the risk of the cash flows of the bondholders affects required returns and will affect yield to maturity. Let's talk a little bit about stock valuation then. As we said, the principle is exactly the same to value stock as it is to value bond. I want the present value of expected future cash flows of a stock, just like a bond. Now, as I said before, the evidence that it's more difficult to value stocks than bonds, you don't need anything more than the amount of trading that goes on in the market. As I said before, if we agree on the parameters of valuation, if we agree on expected cash flow and discount rate, we don't trade very much. That's why bonds don't trade very much. There's not a lot of disagreement. The reason stocks trade so much, there's a lot of disagreement. We have our own views of what the cash flows are going to be and what the appropriate discount rate is, right? So why is it so difficult? What goes into that? Well, the simple fact is the cash flows associated with stock are not known. For the bond, I can pull out a document from the SEC's website and look exactly the date, the exact amount I'm going to get if I buy this bond. If you buy a share of stock in Comcast or Disney or anything, whatever it is, you don't know. Right? They may have historically paid a dividend, so did BP. Right? And as we were talking about earlier, the majority of cash flows are actually coming in the form of share repurchases, not dividends. And share repurchases aren't regular. They do it, they don't. They stop, they go. Right? So I don't know when the cash flows are going to occur, and I don't know how much they're going to be when they do occur. So the timing and the size of cash flows aren't actually known for a stock. Makes it very difficult. Right? Stocks don't have a maturity date. Right? To the extent that your company is a going concern, right, stocks have an infinite life. They go on for as long as the company goes on. You go knock on the door of any CEO of any company, ask when they're shutting down business, are you going to get the same response? We're not. Right? We're going to keep on keeping on. Right? So we have to estimate cash flows not just for 20 years, 50 years, we have to estimate cash flows forever. That's challenging. We don't know what the market rate of return is. We don't know what the market wants. We can fairly easily back out what bondholders want. We can't do that with stockholders. It's quite challenging. It's quite challenging to do that. Right? So I don't know what the cash flows are. I don't know what the discount rate is. It's tough. Right? It's tough. But we march on. Right? We know that if you buy a share of stock, you're going to receive cash flows in two different ways. Right? The company's going to pay dividends, or you're going to sell your shares to another investor in the market or back to the company for a share repurchase. So you know that if I buy a stock, there will be cash flows associated with it. You don't know how much they are or when they're going to be, but there are cash flows associated with it. Right? So our challenge is to estimate these cash flows. Right? If I can come up with some way of estimating these cash flows, I know how to think about the price of the share of stock. It's simply the present value of those cash flows. Okay? So it's just a very, very simple example just to illustrate this. Let's take all the uncertainty out. Right? So suppose you're thinking of buying a stock of this company, More Oil. You expect it to pay a $2 dividend in 1 year, and you believe you can sell the stock for $14 at that time. Right? Here's today. Here's 1 year. Here's your dividend payment. You're going to get $2 if you buy the stock. Here's the price at time t, so at time 1, we expect it to be worth $14. Let's assume you require a return of 20% of investments of this risk. Right? So if you want to do this, you need to get a 20% return. What's the price you'd be willing to pay? Pretty straightforward. Price today is going to be my cash flows in 1 year, discounted back. Right? If I buy the stock, I'll get $2 in dividends, and I expect to get $14 selling it in 1 year. Bring that back to today, I'd be willing to pay $13.33. Right? Another way of saying that, by paying $13.33, I'm going to earn a 20% return. I'll get my required return. Okay. So the principle, once we remove the uncertainty, excuse me, once you remove the uncertainty, are exactly the same as with bond valuation. You set up the cash flows, you discount them to the present, add them together, that's the price. That's the value. Okay. Now, this was an obviously trivial example for many reasons. One is there was only one period long. So let's think about a more general formula where we extend the investment horizon. So let's say you continue to push out the time in which you sell the stock. So you're no longer saying at next period, you're going to sell at some future period T. Now we want to say, okay, what's the price that you'd be willing to pay for this stock? Well, it's going to be, the discounted value of all expected future cash flows. So I'm going to take all dividend payments between next period and the time I sell it, right? And discount each of those back, right? So we have D1, discounted back 1 period, plus we have D2, discounted back 2 periods, D3, 3 periods. Add them all up to time T. Actually, put in parentheses here. And then add the sale price at time T. Right? So it's exactly the same what we did. We're just kind of lengthening the investment horizon and including all of the intervening dividend payments throughout there. Right? You add those all up, and you get your price. Right? That should look a lot like the bond formula written in a different way. in some sense, right? You've got all your kind of cash flows and then kind of your final payment there. It's the exact same effect as the bond. Again, kind of, so that I can make sense of that. Makes sense to me. But we have somewhat of an internal inconsistency here. Can anyone think of what's the problem with this approach? What's that?
Maybe it's not the problem, but if the company has an infinite life,
Yep.
and you're assuming the same dividend,
Yep.
isn't it kind of like a perpetuity?
So you're absolutely right. And we'll get to that in a second. You're right. So for the company's perspective, it has an infinite life. Here I'm thinking about one investor that has a finite life and a finite holding period, right? And so they're going to sell it at time T. But you're right. The company doesn't go away in T. It's just I sell my stock in T.
Eventually it's worth it because in a million years you cover that.
Well, good. Yeah. We'll talk about that in a second. Greg, do you have something?
Isn't the stock price in the future like not being even higher?
Exactly. The whole point what I'm trying to do is just come up with the price today, but you're telling me to know the price today, I have to know the price in the future. As hard as it is to know it today, I think it's even harder to guess what it's going to be at time T, right? So this works, except for it's kind of internally inconsistent, right? So that PT is really causing me a problem. But we can move closer to Mike's comment and say, let's keep moving that hypothetical sale date out. Right? So keep elongating that kind of investment horizon, not 5 years, not 10 years, not 20 years, 50 years, 100 years, whatever, 1,000 years. As you move this out further, what happens to this term? Right? What happens when T is 1,000? What's the value of this term right here? Basically. Nothing, right? You have a finite quantity, whatever it is in the numerator, and something raised to a very high number in the denominator. Right? As this gets bigger, as T goes to infinity, this is going to go to 0. Right? So ultimately, we are left with this formula here. Right? Right? That the price of the stock is the present value of all expected future dividends. Right? So now I've just set T equal to infinite horizon, the whole future. Right? That takes care of my one problem. Right? My PT is now gone. I don't need to know the future price to deal with today's price. I like that. Here's another problem when I think about this. I like this, right, from an intuitive standpoint, but I don't have an infinite horizon, right? I have a finite investment horizon, right? So why should I care about the infinite horizon when I have a finite horizon? Why is it the appropriate valuation model for me when I'm only going to hold the stock for 10 years, 20 years, 30 years? Right? This kind of makes more sense for me, but has a problem with PT. But so I can come down here, but then I'm only going to hold it for 20 years. So why do I care about the dividends 50 years from now or 100 years from now?
It's about what the market is going to pay for it.
When what?
Inflation and
No, you're close. When what? The market pays for it. When what?
When you're ready to sell it.
When we're ready to sell it. Right? So I may only have a 20-year investment horizon. Right? But then at 20 years, I'm not going to mow. He'll be going strong. And so I'm going to say, I need to sell this to you. And so he's going to think about, he's not going to care that much about the dividends during my first 20 years, but he's going to care about his next 50 years of dividends, right? And then when Mo's done with that, he's going to go to our descendants, probably. And so then they're going to pick up that stock and hold it for the next X number of years. And so you can think of this as investors being linked like in a chain. Right? And so when I buy it today, I have to care about all future dividends because when I go to sell it, the next person's going to care about those next dividends. And the next person's going to care about those next dividends. So my price is a function of all future dividends all the way out. Right? I have to care about that. That goes into the price that I'm willing to pay today because as Clayton said, when I go to sell it, it's going to represent all the dividends after I own it. Okay? So I like that. Right? So the price today reflects all expected future dividends. It doesn't reflect anything in the past. Right? Dividends paid in the past may inform me about what dividends might be in the future, but I don't care at all about how much the company paid in cash. I don't get any of that. All I care about is cash flow I receive, right? Or what someone else will receive and that they're willing to pay for. Right? So any past dividends don't go into this. And let me just, as a technical matter here, D0, dividend period 0, I don't get that. Right? I buy the stock at time 0 today. D0 goes to whoever owns it right now. My first dividend I get is D1. Just notation-wise, how we deal with this. D1 is the first dividend I get. That's why we started T equals 1. Okay? All right, so I like this. I like this from an intuitive standpoint. I got to do with PT. It makes sense to me. Here's the problem. In order to calculate the price, you have to calculate an infinite number of dividends. Right? So the question then becomes, how do you estimate all future dividend payments? And we can generalize this with, the book and kind of historically this class is taught. We use the word dividend, but you can think about this as just payout, like either dividend or stock buybacks, if you want to think more generally about this. It's the cash flow that comes back to the investor, right? So how do we estimate all future dividend payments? Right? This gets really challenging. And this is where, right, everything we're going to do from here on out relies on this formula. This is the truth. This is what we're doing. The price reflects all future dividends, right? Right? And so to the extent that Waka and I disagree about what the cash flows are going to be, the dividends are going to be, we can trade. Right? To the extent we disagree about what R is, we can trade. Right? But this is going to underlie all of our valuation models. And again, as I said before, this has nothing to do with market price. A lot of different things that go into market price, investor behavior, and everything else like that we're not getting into. This is intrinsic value of the stock. What is it worth based on the cash flow that's going to be generated? Okay? So our goal now is, how do we deal with this? Right? And so what we're going to do is talk about 3 special cases that make this tractable, that make this something we can actually get our hands around when dealing with an infinite number of dividends. Each of these cases is going to make kind of a little baby step closer to reality. Right? The first special case that's going to help us estimate this is it's the constant dividend or zero growth case. We're going to make it real easy. All the D's are the same. Right? Dividends every period will be the same forever. Things get really easy when you make that assumption. All right? And we'll go through that. But that's going to be special case number 1, constant dividend. Special case number 2, constant dividend growth. So the dollar amount is going to increase, but the dividend is going to grow at a constant rate. Right? There's going to be a constant growth rate. Now again, that's better than just assuming the same dollar amount forever, but that's only going to be applicable to a small set of companies. Okay, that have constant growth, kind of reach a mature phase. The last case is what we generally call the non-constant dividend growth model or the supernormal dividend growth model. What we're going to do is we're going to split the world up into 2 periods, a short run and a long run. In the short run, anything goes. The firm can have any dividend policy they want, including not paying dividends, right? Which we see a lot of firms not doing. That's fine, right? In the long run, every firm is going to settle down into one of the first 2 special cases. So short run, do whatever you want. Irregular dividends, really high, really low, no dividends, you don't care. But in the long run, you're going to settle down either into constant dollar dividend or constant dividend growth. Okay? And we'll see how that all kind of comes together. All right? So again, each case we're taking kind of a little bit of a step closer to reality. All right? So let's walk through some examples of each of these. Let's start with the easiest one, constant dividend. But as I said, let me just I want to reinforce. Right, we're going to see some different formulas up here, but underlying all of these formulas is the fundamental relation that the price today reflects the present value of all future dividends. And this is what we're doing, and everything we're going to do from here on out is going to be written in different ways. Okay? So the first thing we're going to do is all these DTs, we're going to set them equal to each other. Right? We're going to assume they're exactly the same. And so when we do that, right, we're going to have a very familiar cash flow series. Right? These can be annual dividends, quarterly dividends, whatever you want. But they're the same. They go on forever. We have a name for that. It's a perpetuity. Right? And we also already have a valuation tool for that. We know how to value a perpetuity. Right? If you go back to chapter 4, anytime we're dealing with a perpetuity, we simply take the per period cash flow and divide it by the per period discount rate. All we're doing here is naming the cash flow the dividend. So our stock valuation model reduces down to our perpetuity formula if we assume that all cash flows are the same forever. Okay? Very, very strong assumption. You're assuming no growth in the firm whatsoever. all level cash flows, but it helps us get around this problem of having an infinite number of dividends that I'm looking for. Right? So, if we have a company that's a stock that's expected to pay a 50-cent dividend every quarter, right? Every 3 months it's going to pay 50 cents. The required return is 10% with quarterly compounding, and after the exam, I know everyone's bells will go off. Oh, it's an APR. Can't use that. And so the question is, what is the price? Right? And so what we know here is that each of our little D's are going to be 50 cents. And we know that our R has to be a quarterly rate. Right? So we're going to take that 10% and divide it by 4 to get a quarterly required return. Right? And then we solve it, and we say we're willing to pay $20. Okay? And we talked about when we first talked about perpetuities, the fact that, yes, it has an infinite series, but the value of those ones that are far away collapse to 0. Like, I don't care that much about that 50 cents 1,000 years from now. It's not worth too much to me. So even though it has an infinite series of dividends, it has a finite value. Okay? Any questions about that? Very simple assumption, very wrong. Right? There isn't really a case you can think of where that makes a whole lot of sense as a valuation tool. Some people might use it in a different context of preferred stock. So like it's like a hybrid between stock and debt, which might have a fixed cash flow payment. Some people use that for that. But for a common stock, it really doesn't make a whole lot of sense if the companies have no growth. So a second assumption we could make, a second special case, is the constant dividend growth model, or what's also known as the Gorton growth model. Okay? And so here we're assuming that dividends are going to grow at a constant rate. All right? So we're still going to have our D's, but now instead of this we'll have our D1, D2, D3, D4, D5, and so forth. Right? And so what we can say though is D2 is simply going to be D1 times 1 period of growth G. Right? And D3 can be D2 times 1 period of growth. And then we can just substitute this D2 is actually equal to this, so that could go into there. So this is the same thing as D1 times 2 periods of growth. Right? The key is we're assuming dividends are growing at a constant rate G. And that's not going to fluctuate. So you can plug these all back in. Here I'm using D0 as kind of the base case, but whatever the case may be. But here what we're dealing with now is something we dealt with before too. We're now dealing with a growing perpetuity. Right? Cash flows are growing at a constant rate. And we have a valuation tool for that too. Right? If you recall what we said before, the present value of a growing perpetuity is simply your cash flow. So this is time t plus 1, r minus g. You take your cash flow next period and divide it by r minus g. That gives you your value of your growing perpetuity. Okay? Again, from chapter 4. So here, if I want to know the price of a stock today, I'm simply going to take the dividend next period and divide by r minus g. And what's written here, sometimes I know the dividend today and I know the growth rate, so I can just estimate D1 by taking today's dividend and 1 period of growth. Making D1. Okay? So today's a lot about teaching you nothing new, right? So bonds was just putting things together from chapter 4 we've done before. So far as stocks is just using some tools from chapter 4. We're just kind of calling things different things now. But the same present value, same valuation tools we had before, we're now just applying them in the context of a stock. Right? So let's suppose we have Big P Inc. They just paid a dividend of 50 cents. Okay? The company is expected to increase their dividends by 2% per year. If the market requires a return of 15% on assets of this risk, how much should the stock be selling for? What's the price of this stock? Right? So the key here we see is they're going to increase their dividend by 2% per year. I should put the word forever. Right? So forever. It's going to always increase by 2%. With that, we know we're living in special case number 2. Dividends are growing at a constant rate. So I know I can now use my Gorton growth model, my constant dividend growth model, to value this stock. All right? So I know that the price today is going to be a function of the dividend next period divided by R minus G, because it's constant dividend growth. D1, I actually wasn't given D1, right? They told us that we were just paid, that's the D0 talk, right? The dividend that was just paid was 50 cents, all right? But we know it's growing at 2% per year, so I can estimate next period's dividend as 51 cents, 50 cents with 2% growth, right? And then I can use that 51 cents in my growth model, divided by my R minus G, and I get the price I'd be willing to pay for this stock. Again, if I pay $3.92 today, I will earn my 15%. Any questions about that? All right, special case number 3. Okay, as I said, the non-constant dividend growth model. Okay. The special case number 2 we just talked about, you have to assume constant growth. And again, for a small set of firms that maybe have reached a mature phase, and you think they're going to be kind of at that, growing at some constant rate forever, that might be a back of the envelope acceptable approximation. But for most companies, that doesn't cut it, right? So what we're going to do is we're going to divide the rule into the short run and the long run. As I said, in the short run, you can do anything you want in terms of dividend policy. You can have really high growth rates, right? You can have non-constant growth rates, up and down, we're going. You can pay no dividends. That's fine. Right? You want to reinvest everything, as we said before. That's up to the board of directors. You've got lots of good projects. Keep the money. Don't pay me anything right now. Right? But in the long run, something has to happen. Right? You either have to fall down to this is just for a complete set. No future dividend. All future dividends are a constant dollar. All future dividends grow at a constant rate. So essentially, in the long run, you have to be special case number 1 or special case number 2. All right? The first one is just trivial. So that's our non-constant dividend growth scenario. All right? Let me walk through an example to show you how we apply it. And I typically, the way I attack these, you can do whatever you want. I have a 4-step approach to deal with non-constant dividend growth. So I'll share with you kind of how I go about dealing with this. All right? The first thing you do is I divide the future into the short and the long run. I identify what's the short run and what's the long run. Okay? And the way we do that is we have to find out when does the company settle into one of these other 2 dividend policies. That's when the long run begins. When either they start paying a constant dollar amount or a constant dividend amount, constant growth rate, that's when they enter the long run. That's the first thing I have to determine. Step 2, second thing I do is I calculate all of the short-run dividends. So I've identified when the short run is. I estimate all the dividends during the short run, and I estimate the first long-run dividend. So the first dividend that appears in the long run. Okay? I'm going to go to an example that uses this. This is what I'm going to do. The next thing I do is I calculate the present value of all long-run dividends as of the period before the long run begins. Right? So I only estimated the first long-run dividend to begin with, and now I need to estimate the value of all long-run dividends, and I'm going to do it as of the period before long-run begins. I'll show you why in a minute. So assuming we want to know the price of the stock today, the last step is to discount all the cash flows you've calculated back to today. Oh, and add them up. Right? So discount all the cash flows you've calculated back to today and add them up. Right? And we'll use this example to help us go through this process. As I said, you are under no obligation to use this, but I think it's one way to organize the information. The first thing you're going to do when you encounter one of these stock valuation problems is you have to identify which special case am I in. It's going to be one of the three, right? And what you have to look at is what's the firm's dividend policy. If the firm is paying constant dollar, special case 1. If the firm is paying constant growth from here on out, special case 2. Anything else, special case 3. Okay? So it's not 1 or 2, it's by default 3. So here we have a firm that expects to increase its dividends by 20% in 1 year, 15% in 2 years. All right, those go off, special case 3. Right? Certainly not constant dollar, it's growing. And it's not constant growth. We've already shown they're changing the growth rate. Right? So this has to be special case number 3. After that, so starting in year 3, dividends will increase at a rate of 5% per year indefinitely. If the last, this should not say year. If the last dividend paid was $1 and the required return is 20%, what is the price of the stock? Okay. All right, so I know I'm dealing with special case number 3, so I'm going to work through my little algorithm over there to calculate the price of the stock today. Step number 1 says divide the future into the short and long run. When does the long run begin here?
Year 3.
Year 3, right? Year 1, it's going by 20%. Year 2, it's going up by 15%. After that, meaning starting in year 3, dividends are going to go up by 5% per year forever. So starting in year 3, that's the long run, all the way out, and then the first 2 years, that's my short run. Okay? And again, the only way I can really tell is by looking at kind of the long run dividend policy. When does that start? Here it starts in year 3. Okay? Step 2 says calculate all short run dividends and the first long run dividend. So I need to calculate D1, D2, and D3. Okay? And so what I'm given, though, again, if I left out that word year, if it said the last dividend paid, which means D0, I would know that that's $1. So, but I can calculate D1, right? Because I know what it says is that in year 1, dividends are going to go up by, what did we say? 20%, right? Which means D1 is simply going to be $1.20. D2, I was told after that, dividends are going to go up by 15%. So I'll take the last dividend that was paid, which was D1, and increase it by 15%. Is that 12? What did I have there? Is that one?
$1.38.
Thank you. I think it's rounded. That's not that. Okay, so $1.38, and then D3, which is my first long run dividend. I know in the long run, how much are dividends increasing in the long run? 5%. We settled down into our 5% growth. So you increase that, I think it's like 145 and change or something like that. Is that right? Is it 145?
1.44 down is $1.
Okay, so I just have 145. Okay, so that's step 2. I have my 2 short-run dividends and my first long-run dividend. Right? Any questions up to that point? Step 3 says, well, there's not just D3, there's D4, there's D5, there's all these dividends. And as we know, the price of the stock reflects all dividends into the future, right? So I got to capture these somehow. So step 3 says I need to calculate the present value of all those future dividends. Well, what dividend policy am I in starting in year 3? Constant dollar or constant growth? Was it constant growth or constant dollar? Growth, right? It's growing at a constant rate. I know how to deal with that. I know how to value something as constant growth. Right? I simply take the first dividend in the sequence and divide by R minus G. It's my constant growth formula. Right? So in this case, my first dividend in the long run was the 145 rounded. My discount rate, I was told, was 20%. And my growth rate during the long run is 5%. Somebody help Mo with that.
It's $9.66.
So if I calculate that, I get $9.66. Now, given the way this formula works, it always tells me the value as of the period before the perpetuity begins. So that's telling me the value of all of these dividends starting here and going throughout as of period 2. Right? I shrunk that infinite series that started in period 3 and goes on forever down to a single value, 966, as of period 2. It's always as of the period before. Right? So my last step now says, if I want the price today, just bring everything back and add it back. So I got to bring back my D1, I got to bring back my D2, and I got to bring back that value of all those long-run dividends that's sitting out here. This should be P2. It's sitting out here in period 2. Right? So D1 was 120. Bring that back one period. D2. Bring that back 2 periods. And then this value of the long run dividends, I got to bring that back 2 periods as well. So you could kind of lump those together if you want notation wise there. And if I plug that into my calculator, what do I get?
$8.60.
So by paying $8.67 for this stock, I will earn my 20% per year. So anytime I get, go ahead.
There was a kind of a general rule that you said that 966 represented. You said it tells us the value
Of the long run.
right before the long run begins,
Yep.
basically.
Yeah, because anytime we use this, anytime we use our perpetuity formulas or our annuity formulas, right? Whatever they spit out is always as of the period before it begins. Right? So in this case, the long run begins at period 3. That's the first cash flow I use. Right? It then tells me the value as of the period before, which is period 2. So the value that I get, this 966, which is the value of all these long run dividends together, that's as of period 2. Right? Anytime we use the perpetuity formula, anytime we use the annuity formula, it's always that as of the period before. It's like the exam, the midterm question with that 20-year annuity. It's always the period before the series begins.
I'm just trying to follow.
No,
I don't know what question to ask.
That's okay. So again, if I had just asked you, forget this D1, D2 business. If I told you that there was a perpetuity starting in period 3 and asked you what it was worth today, right? The first thing you just go in perpetuity. The first thing you have to do is this calculation here, right? You say, oh, okay, it's a growing perpetuity. I'll use my growing perpetuity formula, right? I put my cash flow, the first cash flow in. I would divide it by R minus G, because that's what we do with the growing perpetuity. And your calculator would spit out 966. Now you step back and say, look, he asked for the value today, times 0. Is that as of time 0? They say, no, because any time I use this formula, the number I get is always the period before it starts. Right? And so in this case, this growing perpetuity, the long run happened to start in period 3. Right? And so this is saying, okay, that's the value as of period 2. Right? And say, okay, well, that's not what I wanted to know. I want to know the value today, so I got to move that 966 back to today. Yeah? Other questions? Right? So anytime I encounter one of these non-constant growth problems, again, the way we know is we just look at the dividend policy. If it's not constant dollar, and it's not constant growth, then it is non-constant dividend growth. And the way I attack these, just the way I organize information to make sure I kind of get through everything, is I follow this step where I divide the future into the short and long run. I estimate the short run dividends and the first long run dividend. The reason I estimate the first long run dividend is so that it lets me estimate all of them, because I know in the long run only two things can happen. Either constant growth like we did, or constant dollar, which is just a perpetuity, right? And we have a formula for that too, right? So then I can calculate the value of all the long-run dividends using one of my formulas, right? And then the last step is say, okay, I want to know the value today, bring back all the short-run dividends to today, discount them back, and whenever it got spit out in part 3 there, bring that back to today too, right? Stack them all together, that gives you your value today. Questions about that? There are at least a couple in the practice problems, which I'm assuming if your exam next week, you'll get jumped right on. When you have time to look at those, take a look at those. There's some, again, this is one of the things, do it a few times, right? However you want to attack the problem, whether you use this approach or not, just work through these problems a few times to kind of get a methodology down, wherever works for you. Okay? All right, a little wrap up here, a couple things I want to wrap up here. What about stocks that don't pay dividends? Right? Many firms do not pay dividends. Google, Amazon, Facebook. We used to have Apple up there, but they fell off the wagon. All right, so the question is, are these shares worthless? Right? Of course not. Right? Some of these companies are the most valuable companies in the world, right? So instead of paying dividends, they plow back the cash flow into internal projects, right? The board of directors has determined that it's more productive for them to use that cash flow reinvesting than it is to return to you as the owner. And if you're not banging down their doors or haven't hired an activist to bang down their door, right, they're going to assume that you're fine with that, right? And assume at some point the door does fall down and the cash has to come out, right? So for a stock that currently pays no dividend, the market value comes from hope of future dividends, see Apple, because if they are really valuable, someday when it does start paying, those are really big dividends it pays out,
Yep.
right? Or, again, just kind of completing the circle, the expectation of a liquidating dividend, that the company's going to shut down and they hand all the cash over. That doesn't really happen, right? The only thing our models say, right, so this is fine. The only thing our models say is that dividends can't be zero in all periods. Because think about that sales pitch, right? I'm a company that needs to raise capital. I come to you and say, here, listen, I need to raise some money. So please give me your money, and I'm going to promise I'm never going to give any back. Right? It's hard to raise capital in that type of environment, right? That's what you were saying. If you say dividends are zero in all periods, and again, more correctly pay out, like share repurchase and everything, if you promise never to pay any money back, well, then you will not get any money, right? But if you say to investors, look, I want you to invest in me, and I have a lot of great ideas, and it's going to be a while before I give cash back directly. Look, you can sell your shares if you need cash or something like that. But that's perfectly fine. As long as I've got a lot of good ideas and I keep, creating that pile of cash, make it bigger and bigger and bigger, investors are fine with that. Okay? But if someday when the well dries up, no more good ideas, I got to pay that cash out. Right? Or fewer good ideas, I got to pay cash out. Right? And the hope in our capitalistic society is that the money that flows out of the more mature companies that the ideas are waning from, that capital then finds itself heading to those other companies that does have the good ideas, and we fund those companies. Right? And so that's how we continue to innovate and grow. All right? Maybe the last thing here in terms of this stock piece. We talked about on the bond side, the bond valuation, that we said we wanted to back out the yield to maturity because I needed to know the cost of debt. That goes in my WACC calculation. That was an important point. On the equity side, I also need to know what we could call the cost of equity and the required return of equity holders. The problem is, I don't have a nice and neat formula to give you to come up with that. Not yet. And even when we get to it, it's not really nice and neat. But, so what we can do, though, is we can at least get a first pass glance at this, kind of what's contributing here. So if we take ourselves to the world of special case number 2. So now we have to make a super strong assumption that the firm is growing at a constant rate. Right? That's what we have now. We've made that assumption. Well, okay, then we can find the price of the stock using growth market. Price equals next period's dividend divided by R minus G. Great. What I really want to know though is this R. What do investors want? What type of return do they want? Well, if I'm willing to make this assumption, if I'm living in this world, I can just rearrange. I can put R on the left-hand side, right? And so just like in the bond example, I can say, well, if I can observe prices, and this is really easy with stocks, you can readily observe a price, right? If I can observe what investors are trading at, I can then estimate exactly what type of return that they want, right? And what happens here is if you rearrange, this breaks down into two pieces. The first piece, D1, next period dividend divided by today's price, we call that the dividend yield. That's the return you get from owning the stock, the return you get from direct cash flow of owning the stock. And if I own the stock, they're going to make me a dividend payment, that's direct cash flow to me. Right? That's one piece of my return. The second piece of my return, which we call generally the capital gain yield, comes from price appreciation. So when I buy the stock, I get direct cash flow, right, through dividends or stock buybacks, and then the stock price hopefully is going up, so I gain that way as well, right? And if I sum the dividend yield plus the capital gains yield, that tells me what investors are demanding right now. Now again, this only works if you make the assumption of constant growth, right? If that assumption is invalid, then this tells you nothing about what investors are demanding, okay? But it does tell you a little something again about the components. The components are going to be some direct cash flow component and price appreciation, how we're going to model that, think about that. So again, very simply, just as a way an example, assume a firm's stock is selling for $10.50. They just paid a $1 dividend, or dividends are expected